Hello friends. Now this week's video, I want to discuss why the banking segment holds the key to the short-term trends of the market. Do remember, we are just a fortnight away from the reported or anticipated day of the budget and second guessing of the budget proposals and position building ahead of the event will start in earnest. Now, there's a reason why I'm saying banking will hold the key. You know me for a statistical data based approach to the markets, and I'm going to present you with ample data to help you form these decisions. Now, let's dive right into our usual format of the weekly video, and on your screen right now is the weekly market roundup window, which tells you that it was the banking segment which lagged yet again, and the broader based Nifty 50 led the charge. The US dollar index or the Dixie surrendered a little bit, which was good for emerging markets, including India, and we saw an uptick in our indices. Now, because the dollar was weak and it's an invoicing currency in the international commodity markets, bullion went up, as did crude oil. Natural gas fell, and I've been writing enough research, sharing my thoughts, etc. on our free Telegram channel as to why that would happen. And there you are. We saw a big 10% decline on a week-on-week basis. The USD INR rose 9 basis points, which means the Indian rupee fell against the dollar. The Indian 10-year benchmark bond yield fell by 1 basis point, which means the Indian bond went up marginally. NSE gained a little under 2.5% in market capitalization, which means the rally was somewhat broad-based. Market-wide position limits or MWPL rose a little under 7%, which is routine after the expiry of any derivative series. And the US headline indices rose, with the technology-heavy Nasdaq leading the way forward, which means there is a probability that our IT stocks will lead in the coming week. Now, friends, my hypothesis as to why banking will be very critical in the days ahead. Now, if you've been following me on my free Telegram channel, please join me. In case you haven't, here are my contact coordinates on your screen right now. And go to my Telegram channel, and in the search string, please type cost of funds, interest rate sensitives, and coupon rates. You will see that I have been telling you interest rate sensitives, which is banking, non-banking financial companies, those sectors which are dependent fairly heavily on EMIs for sales, and heavily debt-ridden companies. I call these 4 broad segments as interest rate sensitives. I have been telling you that they will at some point in time start feeling the pinch because cost of funds is going up. And for banks and NBFCs, money is both a raw material and the finished product. Now, the cost of raw material has been going up because interest rates are rising. This is something I've been telling you since October 2021. And the finished product must also rise, otherwise profit margins will fall. Now, unless you pass on the higher interest rate to the borrower, your bottom line or your net profit is going to take a hit. And secondly, what happened in October 2021, to be precise, 1st October 2021, and I have been taking the lead where analyzing bond markets and their impact is concerned. I told you that the RBI Retail Direct Portal would invite an average Indian and NRI investor to come there, directly trade with the banks without any broker intermediary and any commissions and brokerages, etc. to be paid, and invest in 100% sovereign guaranteed bonds. Now, whether you invest 5 lakhs or 5 crores or 500 crores, both the principal and the interest is guaranteed notionally by the President of India. Take that in comparison with a bank fixed deposit where only 5 lakh rupees are insured by the Deposit and Insurance Guarantee Act. Which means, number one, I get a higher rate of interest in bonds. Secondly, my interest and principal both are guaranteed by the central government, a feat that banks cannot match. So I told you as soon as the retail direct scheme opened up that banks would have a problem in garnering fixed deposits or funds at lower MCLR, marginal cost of funds. Now, here you are, 13 banks which are analyzed by Money Control and other media agencies have found it difficult to garner deposits, and deposit amounts have come down in the quarter ended June 2024. It's completely along expected lines. Now, why is banking important to the overall market? Please take a look at this table. I have been telling you that nothing happens in financial markets without a reason. And since these are financial markets, the reason is also invariably financial. Banking and finance stocks have over 34% weightage in the Nifty, which is the broadest based index traded you can find on the National Stock Exchange. Now look at the other three heavily weighted sectors. You have oil and gas, you have IT sector, and you have FMCG. All of the three sectors combined, their weightages cannot match the banking sector's weightage, which means that for a sustainable bull market in Indian equities, banking stocks have to rise come what may. And I also told you that year 2024 is the year of elections in 5 dozen countries. Economic data would be massaged, heavily weighted sectors would be pushed up so as the stock markets go up. Now here you have the reason why banking has been going up in spite of the fact that fixed deposit accumulation has been slowing down. Cost of funds is rising. The RBI has been raising red flags about variety of issues, including NBFCs and asset qualities of many players. And in spite of that, banking stocks are going up. Now, as we go forward, especially in the last segment of this video, wherein I share my trading strategy for the week, I'm going to suggest actions of how to trade this market. But for now, I proceed to the in-house indicators, and I start with the market-wide position limit, or MWPL. Now, this is basically the amount of exposure utilized by traders compared to the total percentage allowed by SEBI. And what you are seeing is MWPL has risen to 37.78, which is higher than a commensurate week post-expiry in the last couple of trading months. This chart is 20 weeks, which is 5 months. And what you're seeing is after making a higher low post-expiry, the MWPL has also hit a higher high, which means traders are taking additional risks and building up positions ahead of the budget. So risk appetite remains robust. Now I come to the stock and index futures turnover. This is 3 cumulative series. So it is July, August and September. Expectedly, the turnover has fallen because the prior week was an expiry week where rollovers result in dual turnover reporting. So every 4 weeks, you will realize there's a spike only to be followed by a fall. And sure enough, we have a routine post-expiry fall in turnover. So nothing to worry about. Now I come to the advanced decline ratio, which after the price is the most leading indicator of which way the winds are blowing. The Nifty clocked 1.30% gains as compared to 1.79% in the prior week, but the advanced decline ratio rose to 1.56, which means for every 100 losing stocks, there were 156 gaining stocks. So intraday buying conviction was higher as compared to the prior week. Now I come to the Nifty and Bank Nifty prompt month futures basis. What is the basis? It is a futures premium or discount prevalent as compared to the spot. Now, typically speaking, basis jumps after expiry and then slowly but surely starts to slide lower, just like options. Premium as it decays over time. Now, all other things remaining constant, higher basis is higher risk appetite, lower basis indicates lower risk appetite. What you are seeing is that basis fall sharply by at least 50% in both the headline indices, and that means traders were willing to pay a smaller premium on these indices for going long. I now come to our exclusive in-house indicator, the impetus, which you've been trusting for more than 3 years. What you are seeing is that the impetus for the bank nifty has fallen very sharply. It's almost at the low point of the 5 month period or 20-week period. What does it tell you and why am I worried? You see, I've often told you that both these indices, the Nifty and the Bank Nifty, are like two wheels of a bicycle. For the bicycle to move forward safely, the wheels must move in the same direction at the same speed. Otherwise, the bicycle risks falling down or tumbling down. The fact that one index has been rising more than the other, which means the Nifty is rising more than the Bank Nifty in the last 2 weeks, is a slight concern. But a bigger concern is the statistical decline in impetus, which means the Bank Nifty saw very little momentum on the way up on a week-on-week basis. And with a 34% weightage of banking and financial sector stocks in the Nifty, it has the potential to drag the Nifty lower as well. Am I talking about the market falling? No, no, not at all, because these are weekly figures. I update these figures, including the impetus and LWTD, etc., in tabulated format on my social media accounts every single day late at night. So please do make an effort of connecting with me and updating yourself without fail. Friends, I now come to the LWTD, our exclusive in-house indicator you've been trusting for so long. What you are seeing is, in spite of the fact that the Nifty clocked smaller gains, the lift weight thrust drag indicator has risen from 0.39 in the prior week to 0.48 last week. That tells you that on declines, I would expect proactive buying support coming in, all other factors remaining equal and the data points that we have do not change. Now, friends, I come to the bond markets, which are very close to my heart. And like I told you, I've been leading the way forward since many years, covering bonds before the other asset classes, because I feel this market fuels the prices of the other asset class. Now, Indian benchmark bond yields have moved just 1 basis point, but the data points that have emerged are significantly prospectively capable of making a bigger change in the coming weeks. Now, you remember last week on Friday, we had the Indian sovereign benchmark bonds being included in the JP Morgan International Debt Index. And there was a lot of expectation from traders about FII inflows gushing into India through the bond market. And in this video, I have even analyzed what the impact could be. I was very clear about telling and told you that on the whole, there will be a substantial amount of money coming in through the bond market, but don't expect the floodgates to open immediately as soon as FIIs are allowed to invest in our bonds. It's like opening a new shop. Let the buyers come in. They're going to come in, look at the goods that you're selling. They're going to lift them up from the showcase and shop shelf, smell it around, test it around, maybe try bargaining with you a little bit until you establish your business. This is how it's going to be. So it takes a little time. So if bond inflows pick up, the first place you will see it is A, in the Indian 10-year benchmark bond yield, and B, in the USD INR. So monitor these two data points very, very carefully. Keep your ears to the ground. You will be able to hear the hooves of approaching horses the first. Friends, the Indian bond yields done. I now come to the Bank Nifty, which has gained 0.61% last week and thereby underperformed the Nifty 50. As you can see on the daily chart on your screen, it rose on 3 out of 5 trading sessions. The Thursday trading session was an important one because it saw an intraday high being made. It also turned out to be a weekly high. Now, for the momentum to sustain itself, the high must be overcome. For short-term traders, the 51,996 level needs to be watched as a support, and for somewhat patient swing traders, the support is somewhat lower at the top of the bullish wedge at approximately 51,000 levels. The price is above its month-long moving average, so the short-term outlook is positive for now. And now taking a look at the weekly chart, it shows the index has logged 2 consecutive weeks of bullish candles, but with significant upper shadows. That tells me that there was unwinding or selling pressure at higher levels. As a matter of fact, last week's candle is an inverted hammer, which is even more concerning. Am I saying that it's a bear market? No, I'm not saying that. So all I'm saying is that the week's high at 53,358 must be overcome on the upside, that too with goodish volumes and open interest, so that bulls can get back into the driver's seat. Do remember what I've told you, 34% weightage of banking in the Nifty itself. So it's a very critical sector. Unless this 53,358 hurdle is overcome, there will be some amount of overhead supply coming from traders who are stuck at long positions. The index is above its 25-week moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook is positive for now. Friend, in the week before last, this index was number 2 on our most volatile counters list based on statistical beta rankings that I maintain in-house. It fell 4 notches to number 6, which means challenge level fell. Last week, I advocated an estimated range between 54,025 on the upside and 50,675 on the downside, which held perfectly well. In the coming week, I expect an estimated range between 54,350 on the upside and 51,000 on the downside. Friends, the Bank Nifty done. I now come to the Nifty 50, which outperformed the Bank Nifty by gaining 1.30% on a week-on-week basis. It rose on 2 out of 5 trading sessions and peaked out on Thursday exactly like the Bank Nifty before it. Now the peak is at 24,401, which is an all-time high, and the price is above its month-long moving average, which tells you that the short-term outlook is positive for now. The relative comparison between the Nifty and the Bank Nifty index tells you that it is the Nifty's chart which seems relatively more robust as compared to the Bank Nifty. Now, taking a look at the weekly chart, it shows a small or a smaller bullish candle compared to the prior one, and the price is above its 6-month long moving average, which indicates medium-term outlook being positive for now. Now, friends, in the week before last, this index was at number 9 based on our statistical volatility rankings, based on beta rankings that we maintain in-house. It slipped 2 notches to number 11. So challenge levels for retail investors or traders fell a little, which, by the way, is welcome. Now, last week, the estimated range was between 24,625 on the upside and 23,400 on the downside, which held perfectly well. In the coming week, I estimate a range between 24,925 on the upside and 23,725 on the downside. Now, in addition to these ranges, you must also look at the daily, weekly, and monthly pivots that I share on our free Telegram channel. That will help you laser precise your entry and exit levels and improve your profitability even further. Friends, I now come to the retail risk appetite, which basically shows the index futures contributing 4 basis points lower turnover. It is indicated as a blue line. Stock futures turnover fell 33 basis points. It is indicated as a red line. The index options were the only segment that gained where turnover contribution is concerned. It gained 50 basis points, indicated as a green line, and stock options turnover fell by 13 basis points, which is indicated as a purple line. Now, friends, what does it tell you? Futures segment demand more money by way of span margin, mark to markets, extreme loss margins, and exposure margins. So traders were trading less in the futures where capital intensity is higher. You need more money to trade there. In the option space, stock options are relatively more volatile and their turnover fell. The safest place in the derivative segment is index options, and that is where turnover went up. Which means traders were saying, we want to trade, but we would rather trade in the least volatile, least risky instrument. That means risk appetite in the F&O space came down. This needs to improve, or else you might just see a time-wise or even a price-wise correction, especially in the banking stocks. Now, friends, I come to my weekly trading strategy for the week ahead. First of all, I will maintain my tail risk hedges because these are a lifesaver. And in stocks, I will continue to focus on public sector units, which is PSUs. Within the PSU space, it will particularly be OMCs, which is oil marketing companies, energy, power generation, power distribution, and I will also focus on PSBs, public sector banks. Do remember, banks have a huge weightage of 34% in the Nifty itself. Now, am I saying I'll go long or short? No, I'm not saying that. Prices will be big enough in intraday moves in both directions. As a trader, you have to be agnostic. Be prepared to trade in whichever direction your snap quote window or your trading terminal tells you to trade. You are supposed to be like a fireman. A fireman does not predict where the next fire will be. He focuses on being ready whenever he gets a call to come out and douse a fire. So be ready to trade in whichever direction the market tells you, your snap quote window tells you, rather than trying to anticipate how much the price move will be. Oil and gas prices have come down, so inflationary concerns are expected to ease. Bullion is exhibiting signs of strength because of expectations that the US Fed might just ease interest rates a little in the coming Fed meetings. And lower levels in bullion is encountering support from institutional players, as I have been saying since many weeks. Industrial metals on commodity exchanges rose a tad because last week itself I told you I expect some short covering based upthrust in industrial metals. They've been beaten down a little too far, too much. And sure enough, you saw upticks in almost all industrial metals. At higher levels, I do anticipate in commodity exchanges overhead supply to come in and kind of limit the upside or even trigger some amount of selling. That will have a bearing on the stocks of metal mining companies, which might become a little more volatile than its peers. So this sector, metal stocks, might just provide you with more action in the coming week. Like I said, in the banking space, banking and the bond market segment, I will continue to focus on the Indian 10-year benchmark bond yield with a lot more attention than I have been paying in the recent weeks. I'm planning to return back to theta decay in the financial interest rate sensitive stocks, which I used to till before the elections. And I've already shared with you why the banking space is looking a little tired because of the difficulty in garnering deposits. We talked about the RBI retail direct scheme, etc. So the strategy that I told you I promised you I would share with you is a theta decay strategy. Be very careful about it, because at the end of the day, this is a derivative instrument, and although it's a non-linear instrument, you still run a risk. Also consult a registered investment advisor before taking individual calls. I'm just giving you a sectoral outlook. Friends, if there's any more thought process, strategy, broader outlook that I need to share with you, I'll be gladly sharing it with you on our free Telegram channel. Do make it a point to connect with me there. And a request here, please help me reach out to a wider audience and circulate my video within your friends, family, social media groups on WhatsApp, Telegram, Instagram, Facebook, Twitter, LinkedIn, etc. In the comment segment, do let me know how my videos are helping you become a better trader. And if you haven't already subscribed to my YouTube channel, please do so and click on the bell icon to receive instant alerts about fresh videos being put up out here. I thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very profitable week ahead. Take care. Bye-bye.